So today's Cardinal lesson, we're talking about tax planning. So we're looking forward. A lot of times, when we're kind of joking around, a lot of CPAs doing tax returns, they're history teachers. We're looking backwards, like we're completing 2026 or 2025 taxes now in 2026. It's too late to do anything about it. So what we're doing today in this video is we're going to be going through, we got this thing from Ed Slott, Tom's going to be showing you in a second, is we're going to be going through your tax planning and looking at these 8 issues and putting together a plan for you so that you can take advantage of some tax strategies. Tom?
Yeah, so I want to go over the why of the video here. And so we're doing this video because most planning we see clients do, and this might be you, is looking at just a single year. How can I lower my taxes today or for this year right now? And it's often very short-sighted, and you're missing, and it can be costly of thinking about the lifetime tax bill. So all tax planning we're looking at is trying to lower your lifetime tax bill, not any given single year. Because again, we want to look at the less you pay in taxes over the life is the more you get to keep, the more you get to do the stuff you want to do. So let me bring up the show notes. Again, you can find these below the link in our video. They're also on our website at cardinalguide.com. We have the board, and we'll get into more details as we go. This checklist, you might print this off, right? And this is you can sort of go line by line. It matches up with the board pretty closely. And it gives you a little bit more detail than we put on the board here. But again, it's a very good sort of I don't want to say comprehensive, but it's pretty comprehensive checklist of how to think about lifetime tax planning as opposed to just any single year of how to lower your taxes this year. So let me turn it back to Hans, and we'll just go one by one down the board here.
Yeah. So when we're doing a comprehensive tax plan and a comprehensive financial plan, retirement plan for you, taxes is here at the end, but we're going to go through every strategy we have and consider it. We're not going to go over all of them with you, and we're going to recommend appropriate. If you've already got a financial plan or you're not coming to us to do it, this is just going to give you a little checklist, like, have I thought about these things? Do I have a strategy for these? So first, are you exposed to a raise in tax rates? I mean, they said that these current tax rates in the one big beautiful bill are permanent, and I've not seen them use the word permanent and they're permanent for as long as this administration is in office. And future generations, I just see tax rates increasing in the future. Okay. I mean, that's just it's an opinion of mine, but it's based upon just looking at the 28%, the 32%, the 35%, the 22% brackets. Are you prepared? Are you capitalizing on the current tax rates? And are you taking advantage of them? And we're going to talk later about some of the ways you can do that. But when you just look at the brackets, which you had several other videos on those, where you are if you do nothing, and then how much additional tax you could pay or what the rate would be if you took on some additional taxes this year to take advantage of these. Tom?
Yeah, I mean, I think this whole idea is start looking at where we think tax brackets are going to be in the future. Right now, historically, we're in some of the lowest tax brackets we've ever seen. Like Hans mentioned, that in the one big beautiful bill, those are quote unquote permanent. But again, there could be a new administration comes in, new Congress gets elected, and they could change these. Tax law changes pretty often. Uh, it's hard for me to think that they'll go down from here. I think if anything, they would go up. Now, when that happens is anybody's guess, right? I mean, we don't know. But I think thinking of taking advantage of these lower tax rates now, within reason, right, part of a larger plan, I think would be worth considering. When we get to number 2 on the board, are you using the years before your RMDs? So this is a really sweet spot to do a lot of tax planning, right? So one question is, do you know when your RMDs start? And this is something a lot of people don't, right? Because it's changed over time. I mean, I'll just tell you, if you were born prior to 1960, your RMD age is 73. If you were born 1960 and after, your RMD age is 75. So we'll just leave it there, but you need to know what that date is. And then you start looking at how many years do I have before that? So if you're still working and have high income, maybe we're not doing tax planning. Maybe we are, again, depending on the balance of your IRAs and things like that. But especially for people who've retired, and they're not yet RMD age, that is a perfect window to do a lot of tax planning because your income presumably is lower now that you've retired. You have all this money built up in your IRAs or 401ks. We want to try to get it out in a controlled way, really with the goal of reducing your lifetime tax bill. Some of the ways you do that, Roth conversions, right? That's a big one we talk about on our show. Is how do we get this money out? And again, it's not all at once. It's systematically over time. You could purchase life insurance with pulling money out of there. There's reasons to look at that as opposed to Roth conversions. Again, we have other videos on that. You could take it out and spend it, enjoy it, right? I mean, all this money doesn't need to be something to go to someone else, right? Again, some of this you should enjoy, and you worked hard to save it up, so you could spend it, right? So there's a lot of ways that you can pull money out, but these years before RMDs start, you are in control of it. You can pick and choose where money is coming from. When RMDs start, the IRS now is telling you you have to start taking money out, and you might not need it, you might not want it, and now you're on their plan, right? You've lost control over that, and you don't have as much say. So again, that's something to. It's a window of time that is really a way to take a lot of advantage of some tax planning strategies.
Yeah, I mean, it just, the way you do this, take advantage of current tax rates, is considering some Roth conversions or a Roth conversion strategy from now till 75 or 73, if that's when your RMDs start, and do so much a year, do like 50 grand a year for 5 years. And then you'll finish the 5 years with 250,000 in the Roth, which won't have RMDs. Don't forget life insurance. A lot of clients are using a life insurance policy that has a premium spread out over several years, and is going to be taking tax deferred money in the IRA and converting it to tax exempt money inside of the life insurance. So, number 3 here, we're talking about retirement accounts create a tax problem for the heirs. And are your beneficiaries, do they understand the 10-year rule, which was passed during the Secure Act? And I would guess for a lot of, I don't think my adult children understand the 10-year rule. I don't think they'd really even care to listen. But is there a tax problem? When we ask a lot of people about their IRA, like what's it for, if they're not pulling it out and using it in their retirement, they're before RMDs, what's it for? And a lot of people say, well, that's just my inheritance. That's what I'm going to leave. And are you creating a tax problem for your heirs? And would you like to do something about it? Tom?
Yeah, I mean, I think this is sort of the default, right? Is people don't need it or not spending it. And this isn't everybody, but there's a lot of people out there that don't necessarily need this money. It makes our job from a planning perspective really easy, right? There's a pretty good chance you're not going to run out if you're not spending it. Um, but they're leaving a problem for their kids, right? If they ultimately, the goal is to leave this money to them and this balance continues to grow because they're not spending it, you're just building up this tax bomb that you're going to leave to them, and really thinking through what that looks like. I mean, I'll just tell you, most people don't know what this 10-year rule is. You might not even know what that is. We have other videos on that. The scary part is a lot of advisors don't fully understand it. And they might generally have an idea of it, but there's really some nuances there. There's some exceptions that are important to know, and we see them missed all the time. So again, you need to know how the rules work and ultimately how that impacts your beneficiaries and how they receive the money. Because at the end of the day, if you're not spending it and your goal is to leave it to them, then let's do that the most efficiently possible, right? Let's have that be the goal here. How do we give them the most we can and set them up for future success? Number 4, Roth conversions, are they being considered at the right time? A lot of this is a timing thing, right? Is you have this money in the IRA, it's got to come out when RMDs start. And so we're really looking at when we're doing tax planning is the first question is, do Roth conversions make sense? Yes or no? And so we start looking at tax rates now, tax rates in the future, where are they at? And so that's a piece of it. And then it's like, when do we do the Roth conversions, right? Do we start them now? Do we wait till you retire? Do we do small amounts now, bigger amounts then? How do we set up our income? So there's a lot of moving parts here. But again, that is a really it's a useful tool. It's a strategy. These Roth conversions. It's a way to get money out of the traditional IRA, get it into something that's tax free, and that future growth in the Roth would be tax free on it, forever. And then ultimately that money goes to your beneficiaries, like number 3 says, to your beneficiaries tax free. So it's a timing issue. When does it make sense? How much? And that's really where the planning comes into play.
Okay. Are you giving to charity in the most tax efficient way? I mean, taxes are not the main reason to give to charity. You want to give to charity because you have charitable intent. You want to give and give back, help out an organization. That's the motivation. So taxes should never be the motive. But if you're already giving or already planning to giving, then the secondary benefit is you get a tax deduction or you reduce your tax bill. And so we're just asking the question, are you doing it in the most efficient way? Are you using the most efficient assets? If you have substantially appreciated assets, you could give away part of them and possibly never pay the capital gains taxes on them. I mean, there's a bunch of limits and clauses. We'd like to help you out with that. If um, before you do that, you need to make sure you do it properly. Then there's QCDs, qualified charitable distributions. If you're over 70 and a half, or even if you're under 70 and a half, you may want to wait to give a sizable chunk of your IRA. You can do that on an annual basis and not pay taxes on it. They also count as RMDs. Tom?
Yeah, I mean, I think this is an area that we see people make mistakes in a lot, right? I mean, like Hans mentioned, giving to charity is not the primary reason for giving isn't the tax deduction. But if we're going to give and there's a way to get a tax deduction while we're doing it, certainly we want to take advantage of that. With the increased rise of the standard deduction, most people are taking the standard deduction. That might be you, and you're not getting any tax benefit from your giving there. When you hit certain ages, like 70 and a half specifically, you can start giving out of the IRA via the QCD, like Hans mentioned, which is a great strategy. If you have a stock outside of IRA accounts and taxable brokerage accounts, you can give highly appreciated stock. There's accounts, donor advised funds are great accounts to use. So there's a lot of strategies there that you can take advantage of, but it needs to be part of that larger plan to reduce the overall taxes. This sort of dovetails into number 6 here, so I'll talk about it here in a second. But number 6 is 2026 tax rule changes. So in 2025, there is this one big beautiful bill that Trump signed. It extended the tax cuts from his first tax cut and Jobs Act that he passed. So that was good. But there were some other provisions that were put in there, and some that are really going to have some pretty big impact that start taking effect in 2026. One of the big ones is if you earn above certain levels, I think it's around 160,000 or so, starting in 2026. Any catch-up contributions you make to a 401k. So if you're above 50, you've maxed out the normal amount, you're putting in the catch-up contributions above. If you earn above certain limits, those catch-up contributions have to go into a Roth 401k, which is maybe not the end of the world. But if you're counting on that as a tax deduction, you might be surprised when you get your final tax bill. So one, know that that's a big one. There's some other provisions here, right? Back to the charitable giving is starting in 2026. If you're giving amounts to charity and you haven't been able to deduct them because you're just taking the standard deduction versus itemizing, well, now starting in 2026, you can take up to $1,000 for a single tax filer and $2,000 for a married couple. That goes on top of the standard deduction. So that's a nice benefit. So you could still potentially get some there. But again, now timing becomes an issue, right? Because maybe you want to do QCDs. Maybe you want to give 2,000 first out of cash and then do the QCD for the rest of the giving. So again, I don't want to get too far into those weeds. But if you're wanting to give, there might be a lot better ways to do that. Another one is this new senior deduction that's involved starting last year in 2025, but continuing into 2026. Is if you're above 65, you get an extra $6,000 senior deduction on top of the standard deduction or itemized deductions if you're itemizing. There's income thresholds for that, right? So if you're starting to do Roth conversions, which might make sense on every other areas, are you losing that deduction? And is it worth losing that deduction, right? So all of these are connected, and you want to have sort of that plan that pieces all this together to make sure it's the right way. So again, I could go on, but again, you want to look to see, is 2026 different than previous years? What changes happened, and how does that impact your taxes now, but also in the future?
If you own a business, are your tax strategies inside of the business in sync with your personal retirement planning tax strategies? We can help you get those in sync. I mean, there's the recent tax law changes have you, if you have a sub S corporation, you can take an extra tax deduction. If you are a sole proprietor, um, there's things you can do to lower your tax bill. And is that in sync with your personal tax plan? Tom?
Yeah, I mean, I think when if you're a business owner, you need to think about your personal taxes, the business taxes, how those interrelate with each other. And again, the goal here is to reduce the taxes this year and then also for the rest of your life. So again, we don't want to. We could have a whole nother video on business stuff, which we're not going to do today. But I think it's important to look at that. And then number 8 is: are you prepared for the widow's penalty? This is a big one that people miss. And this oftentimes, just from my experience, is sort of this big aha moment, right? We might be getting pushback. We're talking about tax planning, maybe talking about Roth conversions, and we're getting some pushback. Like, I don't know that I want to pay taxes now. I'll just pay them later. I don't want to worry about it. I don't really care if my kids have to pay taxes. And then we talk about this, and then sort of the light bulb goes off. It's like, oh man, I actually do need to start thinking about this. So what a widow's penalty is if you're a married couple and the first spouse passes away, now that surviving spouse is filing taxes at the single tax filing rate on into the future. If we think about, the IRAs, for example, the IRA balance hasn't changed when the first spouse passes away, right? So that account balance is still there. You might be into your 80s, where RMDs from a percentage standpoint are a lot higher. And now you're having to take a dollar amount out that's exactly the same as it was, again, assuming the same ages, that it was previously, but now we're filing taxes at the single tax filing rate, which are much higher. So that's a big issue there. IRMA becomes a big issue, right? IRMA is this increased cost for Medicare if you earn above certain limits. We have a lot of people, they know about IRMA. Maybe you learned about it from our shows, and they're worried about it, and they're trying to avoid it at all costs. Like, I don't want to pay it. I don't like it. I'm not converting up to the point where I got to pay more of that because I just don't want to. And then we start looking at, okay, I mean, that's fine now, but what happens when the first one of you dies? And you start mapping that out. They might be pushed into the second, third, fourth layers of IRMA, right? Up into the higher brackets where maybe it's okay to pay maybe the first bracket of IRMA, maybe the second bracket of IRMA now to avoid the higher ones later when the first one passes. So that's some of the thinking that we do. Again, none of this is recommendations. We need to look at it as part of a larger plan, but we need to start thinking about taxes now, but also taxes in the future, with the ultimate goal of all of these is to lower your lifetime tax bill, not just look at this individual year of that. And again, this widow's one is a big one to think about.
Okay. So, in terms of comprehensive financial planning, we've been talking about taxes all day, but estate planning, we've talked about that. Income planning, we talked about that with RMDs. We've talked about IRA 401k planning and Roth conversions. We haven't really talked about long-term care today, nor have we talked about Medicare other than IRMA. I guess we did talk about that. And taxation on your Social Security check. That gets thrown in there. But, we do comprehensive financial planning here at Cardinal. A lot of times when people call us, they're interested in some solutions for one or two of these subjects, but then it transfers into let's do a whole retirement plan. Let's take all 7 subjects and let's apply them to you in your situation. That's what we do at Cardinal. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.